Oil-driven inflation risk is colliding with an AI-powered earnings story, and that collision is now spilling across every major asset class. Equity leadership is wobbling, yields are backing up, and commodities sit at the center of the macro debate. You're watching vTalkInsight, Allocator's Lens Daily for July 14th, 2026. Let's start with equities, where the tug-of-war between geopolitics, rates, and earnings is front and center. Equities are caught between a still powerful earnings story and a clear turn toward risk-off in the near term. The pressure is coming from higher oil, higher yields, and a spike in volatility around AI and semiconductor names. In the United States, recent sessions have seen the S&P 500 down around 0.75%, with the Nasdaq falling closer to 2% as crowded technology trades are cut back. Asia has been even more dramatic. SK Hynix has dropped by mid-teens in a day and is now more than a third below its peak, dragging the Kospi into a 9% slide and triggering circuit breakers, while that shock spills over into global AI chip names and European tech, with indications pointing to a weaker open across the region. Underneath the de-risking, the fundamental growth picture still leans positive. Semiconductor leaders like TSMC are reporting quarterly sales growth in the mid-30s, with individual months up more than 60% year-on-year, and AI-related chip revenues are now running near $100 billion after starting from almost zero 2 years ago. For the S&P 500 overall, second quarter earnings are expected to rise about 20% year-on-year, with upgrades across most sectors over the past 3 months, reinforcing confidence in the profit backdrop. The fault lines are valuation and concentration. The index price to earnings multiple sits in the mid-20s, industrials are flagged as rich on long-term metrics, and AI capital expenditure is highly concentrated in a handful of mega-cap U.S. companies. The SK Hynix experience shows how quickly profit-taking and cross-market arbitrage can hit a perceived secular winner, even though memory supply is expected to stay tight for years and demand for AI infrastructure keeps accelerating. Geopolitics is the other swing factor. Rising oil linked to Strait of Hormuz disruptions is hitting airlines and other energy-intensive sectors, while energy producers and UK-listed oil majors are outperforming, leaving European benchmarks with heavier industrial and energy cost exposure looking more vulnerable than United States indices if crude remains elevated. Over the coming days, the combination of a heavy earnings slate for the big U.S. banks, a key CPI print, and already elevated exposure to AI themes suggests that equity returns will depend less on the growth narrative in isolation and more on how that narrative interacts with rates, energy, and event-driven volatility. With volatility indicators such as the VIX moving higher but not yet in panic territory, equities look set for a more tactical, path-dependent phase rather than a straightforward trend. Rates markets are being driven by the intersection of energy prices and inflation risk. As oil climbs on renewed Middle East tensions, yields across the curve are grinding higher, and the debate around higher for longer is firmly back at the forefront. U.S. 2-year yields have pushed above 4.2% and are revisiting highs last seen early last year, while 30-year yields have moved above 5%. Earlier this year, short-dated yields were rising even as 10-year break-even inflation fell, underscoring uncertainty over how persistent price pressures will be, and some long-term fair value estimates now cluster around 4.75 to 5% for the 10-year, suggesting limited room for a lasting rally in duration unless growth slows more sharply. For the Federal Reserve, the picture is messy. Services inflation remains above 3%. The labor market is still relatively tight, and there are clear upside risks to energy and food prices into the second half of the year. Markets are currently pricing one additional hike followed by cuts, but Fed officials are signaling a preference to hold rates steady for several meetings and react to realized data rather than provide strong forward guidance. That makes this week's United States CPI and PPI releases critical. Headline CPI is expected to show its first month-on-month decline in years, largely reflecting earlier weakness in energy, and consensus looks for a 0.2% core print. But anything closer to 0.4%, especially against the backdrop of oil supply disruption, could quickly reprice the policy path and push yields higher again. Outside the U.S., idiosyncratic risks add to the volatility backdrop, with France's elevated debt load and elections keeping its bonds in focus. While in the UK, talk of fiscal reset is being balanced by commitments to existing budget rules to avoid unsettling gilts. With traditional 60-40 portfolios already under pressure as both equities and bonds sell off together, the path of yield from here is central to how multi-asset risk budgets evolve. Credit markets still look resilient on the surface, but the balance between carry and risk is becoming more nuanced. Spreads remain tight, capital markets are open, and there's been heavy large-scale issuance, particularly from high-quality borrowers linked to AI infrastructure. Within that, investors are starting to demand more compensation. Recent jumbo technology bond deals were absorbed, but with less enthusiasm than earlier waves and at higher required yields, as portfolio managers sell older bonds to make room for new supply and demand becomes more selective across maturities and issuers. Even so, most hyperscaler issuance remains firmly investment grade, and some allocators view it as a relatively stable way to access the AI theme compared with more volatile equities. Banks are an important swing sector for credit. Large U.S. institutions are expected to deliver mid-teens to 20% earnings growth with high capital ratios. Yet the outlook for deposit costs and net interest margins is a concern, especially for regional banks without sizable capital markets franchises, since if front-end rates stay elevated without a steeper curve, profitability could come under pressure and rating momentum could fade. Outside public markets, private credit remains a major magnet for institutional capital. Fundraising is strong, and many see recent price declines as having overshot fundamentals. Yet direct lending volumes have dropped by about half quarter-on-quarter, reflecting a more cautious deployment pace. For multi-asset allocators, the message is that funding remains available and systemic stress is limited, but the easy phase of spread compression and broad-based beta appears to be behind us. Foreign exchange is where the moves in commodities and rates intersect. The U.S. dollar is benefiting both from higher yields and from its position as a net energy exporter at a time of renewed oil shocks. When oil prices rise, the United States terms of trade generally improve, while those of large importers deteriorate, putting pressure on their currencies. That dynamic is now layered on top of geopolitical tension around the Strait of Hormuz and a still elevated U.S. policy rate, keeping the dollar supported against lower-yielding peers and reinforcing its role as a defensive asset. The yen remains the main funding currency in this setup. It has weakened following signals that Japan's government pension fund is not yet incentivizing large-scale capital repatriation. And with the Bank of Japan still far from the Federal Reserve on policy, yen-funded carry trades remain attractive as long as volatility stays contained. For oil importing regions, any currency weakness on top of higher energy costs tightens financial conditions further, making the FX channel a key way in which the commodity shock feeds back into local growth and equity valuations. Commodities, and energy in particular, sit at the center of today's cross-asset story. The U.S.-Iran confrontation has escalated into repeated strikes, attacks on commercial vessels, and damage to infrastructure across Kuwait, Qatar, and other Gulf states, while shipping through the Strait of Hormuz has dropped to multi-week lows, with many tankers sailing dark and some satellite data pointing to a near halt in observable traffic. Oil has responded with a series of sharp spikes. Brent has logged daily gains of up to 10% and is up double digits since the latest hostilities began, and market estimates suggest a risk premium of around $5 to $6 per barrel. At the same time, some analysts argue that stronger output from the U.S. and the UAE will keep a structural glut in place and cap prices below $100, while Iran is exporting more than 2 million barrels per day at higher prices, reducing its incentive to de-escalate quickly. Refined products and gas markets are also tightening. Global refining capacity is estimated to be down about 10%, with outages in Russia and reduced Chinese exports pushing refinery margins to record levels. And European gas prices have risen as LNG flows are disrupted and extreme heat strains power grids and nuclear output. Rising electricity demand from data centers is further lifting costs for natural gas and renewables, reversing years of declining solar and wind prices and reinforcing energy as a bottleneck for AI expansion. Gold, in contrast, is not acting as a straightforward hedge. Despite geopolitical stress and strong central bank demand, Bullion prices are under pressure from higher rate expectations and persistent ETF outflows, and major banks have been trimming their forecasts. For multi-asset allocators, the key question is how long this energy-driven inflation impulse lasts, and how central banks and earnings adapt to it across the rest of the asset spectrum. Stepping back, the cross-asset picture is one where an energy and geopolitics shock is pushing yields and the dollar higher, even as AI-driven earnings and still open credit markets keep risk assets from breaking decisively lower. Equities are balancing robust profit growth against richer valuations and event risk. Rates are repricing a higher-for-longer path as oil feeds into inflation uncertainty. Credit is shifting from broad beta to more selective carry, and commodities remain the fulcrum that links everything through funding costs, sector rotation, and foreign exchange. For allocators, the next catalysts are clear: United States inflation data and Fed communication, earnings from the major banks and key AI suppliers, and any further disruption around the Strait of Hormuz. Those will determine whether we stay in a choppy late cycle grind or shift into a more decisive risk-on or risk-off phase. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.